Hi everyone, hope you're all doing well. Today I'm going to do my top 20 stocks for 2025. So you might have seen that Paul Hill and Paul Scott did something similar, and a lot of you guys have asked, Jacob, can you do one for your list of the top 20 picks? And I'll do that for you today. First of all, apologies, the video is really late. I did record the video once and it failed, and then I was absolutely knackered from work, so I fell asleep on the settee. But back up again now and recording this video, so apologies for the late upload, but otherwise there would be no video on a Friday/Saturday morning, I guess. So apologies for the delay in that here. I have picked 10 UK stocks and 10 US stocks because obviously I do like to invest in both of the markets. Does mean I've missed a couple of stocks that I would like to put on the list, off the list, because there wasn't enough room for them. But apart from that, I hope you enjoy it. Let's get started. Now, just a quick shout out, if you do want to support the YouTube channel and get 2 exclusive videos a week, we'll be doing them over this weekend on the Patreon. Join for the link in the description, £6 a month, and I'll also post what I'm buying and selling in real time on there. Let's get started. So I'm going to start with the US stocks first. First of all, evolution, depending where you're from. No surprise that this was going to be on the list, was it really? I think I've called this my number one stock for 2025, which obviously is a pretty big statement to make. And yeah, I think that this is a good stock to have as my current number one pick. And it's probably a good decision to start with this one first. iGaming in the US, these guys provide games to the likes of DraftKings and FanDuel, and then they just take a cut for the games. They actually don't make the games on the website. Stock peaked during 2021, everybody was at home kind of doing their iGaming, the sports betting, and the valuations went a little bit crazy, as we know. But for the last kind of couple of years, well, 4 years, the valuation has caught up to the financials, and I'd actually say the valuation has gone below the financials. And I think that's an opportunity right now, down 42%. Right now, 13 times earnings. This company normally trades at a bit more of a premium than this, 25, 30 times earnings. You get a nice dividend with this one. If we do have a look at evolution on a financial point of view, the company next year is expected to go from $5.33 up to $6, so nice growth there. Puts it around about 11-12 times forward earnings and 12% growth. A little bit slower than what they've normally done, but what will happen is a few more states will come online with the iGaming, and I think that will start driving the growth up even more. So yeah, big fan of this one. I'm sure you knew it was going to be on the list. Leads me on to my next one, which is AMD, Advanced Money Destroyer, as it's been called the last few years. Fallen a little bit behind Nvidia, originally when all the AI hype started. A lot of people thought these guys will do as well as Nvidia. However, that did not happen on the financials, and it's caused the stock to dip quite a bit. In my opinion now, AMD is catching up to Nvidia. The technology is catching them up. We've seen that with the likes of the data center growth. That's been growing at 120%, which is the highest gross margin part of the business. And what will keep happening is that will keep translating into higher profit and revenue growth as the AI demand keeps going up, and AMD's products are now starting to catch up the likes of Nvidia. If you look at an EPS point of view, going from $3.33 up to $5.13. You look at revenue growth, 25% expected this year, which is a big growth improvement from last year in 2024 of 13%. If we do look at a forward PE right now, sitting around about 23 forward times earnings, I think that's a very good valuation for AMD and the growth that they could potentially do. I'm only going to spend a minute or two on these companies, guys, so I can get them through them all, because obviously for 20 stocks to get through, if I did a 5-10 minute talk on them, would make the video very long. So I hope you're okay with that. Next one, Google. So I have done very well on Google stock over the last few years, and I'm up a lot. I still think Google is a fantastic company and is a buy at the current levels right now. You are getting Google search, YouTube, you get the free bet with like Waymo, for example, and they'll continue to do very well for many years. And as well as that, probably one of the best balance sheets in the world. If you look at the numbers have been very good as well still. EPS is expected to go from $7.86 up to $8.97. Revenue growth expected around about 11.6%. And for all of this, you're getting one of the best, if not the best company in the world at 22 forward times earnings. So yeah, still pretty good valuation. Personally for me, yeah, if you get this company around about 18, 19 forward times earnings, then that's when you start being quite aggressive on it. You shouldn't be getting it below market valuations. But yeah, I think Google is a very good pickup if you can get it, especially at 18, 19 forward times earnings around there. Next one, Celsius. Energy drink seller. Energy drinks are doing very well at the moment, and especially in the teens. and the teens' number one brand for energy drinks at the moment is Celsius. They've pretty much conquered America, competing with the likes of Red Bull and Monster. They're now expanding to the likes of Canada, and also they're expanding to the likes of Europe right now. There was a little bit of an issue. I had this stock for a few years, made a good ton of money on it as it went up. Originally thought I sold this stock a little bit too early as it continued to go up, but then it gave it all back. I did start buying a little bit ago, and it has gone a little bit further from when I started buying, but in the words of Cockney Rebel, there's a little bit of a ball shape forming here, which is worth pointing out. So I am down slightly on this position, but even with the average that I do have, I think I can actually still do okay from these sort of levels here. And like I said, there was an issue because of Pepsi. Pepsi bought a stake in them, which you would normally say, that's great that Pepsi bought a stake in a business. However, what also happened is they did say they would take over the supply side of it. Celsius said you can only take over the supply as long as there's no inventory hiccups, and Pepsi said sure, so we're going to order a ton. Now, what happened is they ordered that much that Pepsi eventually turned around and said, we've actually ordered too much, so we can't order any more for a little bit. Because Celsius count their sales as when they give them to Pepsi, and because Pepsi aren't ordering at the moment because they've got to get through the supply, the numbers have recently dropped down massively. What's going to happen is the supply though has gone in this month, or last month, so next year the financials are going to start coming back, and we're going to see like the EPS go from 0.69 up to 0.94, and we're going to see the revenue as well come back with nearly 15% growth. You're picking this up for around about 28 forward times earnings, 28 forward times earnings, which is about where Monster normally trades at, and Celsius is a lot more earlier in its growth stage than Monster, and I think very quickly if you look at the numbers that they will grow at 10, 15, 20% a year, that valuation very quickly looks very cheap for Celsius, so I like it here. Next one, Mercado Libre. So I've had this one as well for a few years, done very well on it, I'm up a lot on it. However, it's currently having a little bit of a dip at the moment, and I think that's a little bit of an opportunity once again to go get Mercado Libre at a bit of a good valuation. They are a payment system, online banking, Mercado Pago in Latin America. They also have the e-commerce side of it, which is like the Amazon of Latin America. They were able to take that title before Amazon could do it, and Latin America e-commerce is about 10 years behind the UK and the US at the moment, so you are getting it at a lot earlier stage. So we know this is going to continue to go or grow for many years. If we do look at the financials, there is a big improvement on the EPS expected, $34 up to $47. Revenue growth of 23%, which is a little bit slower than last year's. Quite often they do beat these numbers. Mercado Libre itself doesn't actually guide on its numbers, and then quite often we see these big beats that come out. The other kind of wild card you have in Mercado Libre is sometimes the currency impacts, because obviously they operate in a lot of the local Latin America currencies and then do it to dollars. Depending on what happens with the currencies, there could be a few fluctuations there, but overall, yeah, I really like it, and you get a lot lower valuation than what it normally is, around about 41 forward times earnings. This company normally trades like 60, 70 times earnings, which obviously is a little bit cheaper than where it normally is at. Going on to number 6, which is another Latin America company, which is New Holdings. So this is basically like Mercado Pago, the payment method, but just payments. So New Holdings just do payments in Latin America. The growth of online payments, online banking, as people start using online websites more and more in Latin America. New Holdings though just has exposure to 3 countries, in particular Brazil. So a little bit more risk maybe with the currency impacts in Brazil. But when you look at the risk to reward, I certainly think there's definitely that reward there with this one. EPS is expected to go from 0.44 up to 0.61 and 32% revenue growth. Don't forget there could be some impacts with the FX once again, but very good numbers, and you are getting the little bit more reward here because compared to the likes of Mercado Libre, for example, you'll be picking this one up at about 19 forward times earnings, which obviously is a pretty good valuation for the growth that you potentially could get with this one. Next one, my number 1 holding, Hims and Hers. So a stock that's done amazing for us. The investable stock at $3. Now we're up 300% on it. Now Hims and Hers is still going to make my list. I would be very happy to add Hims and Hers if it has any dramatic drops, which very much can happen with Hims and Hers, and I could add into it. Yeah, even though it's done absolutely fantastic, I still think there's very good upside here with Hims and Hers. You're still picking this company up at around about 57 forward times earnings, and when you do look at the growth that they do throw off, it's fantastic. EPS is expected to go from 0.87 up to 0.98. They always sandbag the numbers and beat them though. This could easily get into a $1 range, and revenue growth of 42%. Same again, they always sandbag this and increase the range. Last year we were expected 67% growth. Obviously we've still got Q4 to go, but last year, I think the start of the year, the growth expectations was like 28% revenue growth for this company, and obviously we ended up all the way up 67. So this year, 42%, a little bit higher than what is normally predicted at the start of the year, but this could easily get hiked up as the year goes on. So yeah, one of the best companies out there on the market, and I would still be happy to add this, and I still think it'll have a good year. Leads me on to my old number one holding, now my number two holding, which is DraftKings. So DraftKings is a stock that I've been a little bit more negative on. I actually remember saying to you guys that I actually think it could underperform a little bit this year, and that's what it did. Well, last year I should say. Though the setup is a lot better for it now. So the valuations really come down on it. So it's had a bit of a valuation catch up. Now 33 forward times earnings, which is actually pretty cheap when you look at it. And when you look at the company right now, the EPS is expected to go from 0.3 to 1.46. So the key thing for this company is if it hits its guide. If it hits its guide, this will have a really, really good year. That's what we're all looking at. Growth-wise, 31% revenue growth, that'd be good if it gets there. Obviously, the growth is pretty much secured because we know there's loads of states to come on for many years, so there's no issue there. It's the ramp up in profitability now, and if they get anywhere close to these numbers that's expected this year, yeah, I could see DraftKings having a very good outperforming year this year. That leads me on to the next one, which is InMode. So InMode is a stock which has had a couple of disappointing years. This stock has, if I just go on the stock chart, really peaked during that time frame and struggled in the last couple of years. Sells expensive equipment, so with interest rates going up, people have been a little bit more hesitant to get those higher interest rate products that they do sell. But if the interest rates are going to start going lower, hopefully it does start bouncing back. People always forget though that this company only needs slightly to go back to a slight bit of growth because they make that much profit. They can keep throwing that profit off into share buybacks and the stock will do very well. So we're looking for this to go back up to being growing and it will do well. You know, you're picking up at 8 times forward earnings and the profit margins are like 50% on this business. So they can just throw a lot of cash into that share buyback and that will help the stock do very well. But if it gets that slight little bit of growth, this stock will absolutely fly from here. And right now, we're seeing the EPS of $1.86. Expect to go to $1.98. If they can do that, the stock should do well. Revenue growth of just short of 2%. If it starts flattening and starts going up a little bit, that'll be really good for InMode. And like I said, they can just keep throwing that into the share buyback and that'll improve the EPS. And I think today the CEO actually came out with a bit of a big buy on it as well. So that's a really positive sign to see. And that leads me on to the last stock, which is not actually technically a US stock. It is listed on the NYSE. It's a Chinese stock though. So I don't know if this was the best one to finish on, which is Alibaba. So Alibaba had a big fall off in the last kind of few years and it stayed flat for so many years now, as a lot of Chinese stocks have. But I look at the stock and the financials keep moving up in the right direction. At some point, I think the share price will start moving up in Alibaba. Pretty good valuation right now, 8 times forward earnings. Yes, it is going to be at a discount because it is a Chinese stock, but I think probably 8 times is a bit too low for this company. I would argue the case that maybe like 14, 15 should maybe be somewhere where it's probably valued at. If we do look at the analyst expectations, they are expecting the EPS to go from $62 up to $70. That'd be very good if they do that this year. And revenue growth of 8%. If it just keeps increasing the EPS like that and the revenue keeps going up, a high single digit every year, yeah, I think this stock should be more towards 13, 14 times earnings. So yeah, there's a concerns around Trump at the moment and maybe tariffs, but I think a lot of that is overblown. At the end of the day, what Trump will want to do is he wants to grow that economy and he won't want inflation going up. I think a lot of it is talk on a lot of these tariffs at the moment as start in public, act the hard game. Realistically, that's negotiation. When you get to the table, he's not going to do anything too stupid, and I don't think they'll get hurt any more than a lot of these Chinese stocks have already been hurt. And that is the end of the US stocks. So those are the first 10. Moving on to the first 10 UK stocks. First one is Audioboom. So they came out with an update this week. Very good update. I think this company is going to start pushing towards 5-10% profit margins. People are sleeping on this. 100 million in revenue in the next few years. That's going to lead to about 5-10 million in profit on a 70 million market cap. If they get towards 10 million in profit and a 70 million market cap, the stock's going to be probably 2 to 3x from where it currently is right now. Analyst date I don't think will be great on this one because it's a UK stock, so yeah, there's only one analyst kind of covering it here, and I think these numbers here they're going to be, so I can't really show you any numbers really on this one, to be fair. Yahoo Finance is probably not the best website to be using for UK stocks compared to US stocks, but it's the best one I've got at the moment loaded up for you guys, and I'm not getting another one up. Next one is B&M. So yeah, B&M retailer, you're getting a nice little dividend on this one. In fact, it's a little bit higher than this, so once again, bit of a bad data on this one. Also, if they do the special dividend, that even puts it up to like an 8% dividend yield. Numbers, yeah, a little bit weaker than what maybe people have hoped for, but they're still being very good considering how weak the environment has been in the UK and how weak the high street environment has been. I think a few people expect B&M to put in mega numbers when the high street has been weak. When you consider the high street has been weak, the numbers in my opinion still look good, and also they've got the expansion into France going on. That is great, and obviously if they double the stores in the next kind of 5 years, then basic maths tells you, close to revenue doubling, profit doubling. The share price should be maybe double. But even though the share price right now is in the £3 range, I think this is too low, because right now you're picking up a company at 7 times forward earnings. Most retailers should be trading in the UK, if they're a good retailer, 13-14 times earnings. Yeah, I think this is probably a little bit too low for the likes of B&M. Next one. One of my growth stocks. I don't really have too many growth stocks in the UK market. It's hard to find growth stocks in the UK market, but this certainly is. It's a bit like Evolution. They do iGaming games, but instead of doing like the live casinos like Evolution do, these guys do a game called Slingo. So you might see Slingo on a few of these betting websites. And this company has stayed stagnant for quite a few years now, a bit like Evolution, but the financials just continue to absolutely smash it. The profit has been ramping up massively. The revenue growth has grown at 16% in 2024. This year expected to be 13%, but like I said, if more iGaming states come online, expect that to start going up a little bit more. And right now, you're getting a company that's growing at double digit at 8 times forward earnings. This is I think this is just way too cheap for a company like Gaming Realms. Now, JD is the next one. I've just got to make sure I get the right one up and not JD.com, not JD Wetherspoons, but JD Sports. So this company has had a bit of a fall off in the last kind of couple of months. I don't know why, because for the weak environment the UK has been in, the numbers have been very good in my opinion in JD Sports. And this has put it to a valuation that's just way too low, 6 times forward earnings. I mean, this is a quality high street retailer in the UK and also the US and Europe. We should be talking, even Foot Locker's 11, it's more than that, isn't it? It's like 14 times forward earnings, and they're absolutely crap. So, JD Sports should be, in my opinion, like 13, 14 times earnings, and very quickly looks, incredibly cheap. And people said that the numbers weren't good this year, but they were good. Revenue growth of 8%. Next year, expecting 11% revenue growth. If they hit those numbers, I don't know why the market's putting this one so low. Next one is a veterinary service, which is CVS Group. I've got to click on the right one and make sure I don't go for the healthcare one in the US. CVS Group is a veterinary service in the UK. They've been hurt because there is an investigation going on to the vet services that they do, and everyone else does as well, to be fair. People saying that there's a bit of a monopoly, they're charging too much. I don't think so. Their profit margins sit around, I think it's like 8% or something. You're not charging that much if you make an 8% profit margin. That's a pretty decent valuation for a vet service or a company in general. You're not absolutely fleecing your consumers at them sort of levels. But there's a lot of fear that's being created in the stock, and I look at the stock right now. And I think it's an attractive value there's the risk hanging on it, but you're picking up this stock right now that's currently 9 times forward earnings, and the financials have held up. The recent financials have been pretty good, profit pretty healthy still, revenue still been growing at the right rates. Yeah, I think that this is a good space to be looking at. I think a few other people have been buying pets at home actually as well. That leads me on to Money Supermarket. So yeah, I've added it into the list. I've been a little bit concerned that maybe the energy switching market won't come back as soon as I thought, and interest rates are not maybe getting cut, and that will hurt them because they obviously do interest rate sensitive products like mortgages and maybe like car loans. So yeah, maybe the environment isn't as good as what I would hope for this one, but I just look at it and I think, you know what, even if it doesn't do well, you're going to pick up a 7.5% dividend realistically from this one right here. The lows that it's at is like the lows of the Liz Truss time. It's lower than where it was. It's all the way back to where it was in 2014, which shows you how much it's kind of being beaten up at the moment. And if we look at the valuation, I think it's like 9 times forward earnings. 10 times forward earnings. That was a pretty good guess. Look at the financials. They've all been moving up in the right direction. Yes, sure, the growth has slowed down a little bit, but when these products start coming back, that's where the growth will come back, and they're still growing at okay rates considering. But yeah, there's definitely, when these things do come back for them, I do think the company will do very well for them. Next one is a makeup brand from the UK, which is Warpaint. So originally a makeup brand in the UK, but they've expanded to Europe and into the US. They're trying to crack the US at the moment with partnerships with the likes of Target, for example. Do pay a slight dividend, so you get a 1.85% dividend here. The growth has been amazing though, because they've been taking good market share in Europe and the US. The profit's been ramping up massively, as you can see here. And 17% growth last year. This year expected 18% revenue growth, which is good. We don't have many companies like this growing that much in the UK markets. And it's all not for too bad a valuation, which is something like 18 times forward earnings, I believe it is, or 19 forward times earnings. So Warpaint is looking good, and if it can do anywhere close to what it's done in the UK into the US, it should do very well. YouGov, probably the most risky one I'm going to say on this list, came out with a profit warning last year, which shocked us all. Or they were like, yeah, we're in line, and then very quickly they went, yep, we're actually not doing that well. So a little bit of trust may be lost from the management team here, but if they are going to do what they said it's a one-off and they're going to start bouncing back, this could potentially look very cheap very quickly. If we do look right now, the drop has kind of put them towards, I think it's a 9 times earnings. So we'll see if they do what they're supposed to do. Next one, Card Factory. So another retailer on the UK high street. They came out with an update this week. I thought the update was fantastic, but yet the stock is still not really moving off this update, which is really strange to see. We had a big drop here back in September time. Market got spooked thinking you can't hit those full year numbers after seeing the H1. And what management team in Card Factory did is once they came out and said, yep, we're still going to hit it. They said again they're going to hit it. And what happened this week is they said, yeah, we're going to hit it. And even though they're going to hit the full year financial targets, the market still hasn't bought it up. It valued it all the way up at £1.37, now down at 92p. It just doesn't make sense because they are at the same point where they were 6 months ago when the market freaked out, and it's giving the confidence back that they're going to hit the full year numbers, yet still it's down at these levels, which is just bonkers. 6% dividend yield as well on this one. And if we do look at the valuation, they currently sit at a 6 times forward earnings. That's just insane. They should be probably like 12, 13 times forward earnings. And the growth is looking good on them. Even next year, they're expected a decent jump in the EPS. And that's with the big NI increases coming on them as well. So yeah, Card Factory, yeah, I like that one. And that leads me on to my last UK one, which had to be something construction related because they're all being in the dumps. And I did end up, I put Barrett Developments in, and it's not Barrett Developments anymore. BTRW Redrow. Barrett Redrow was the one that I did put in because I do own it, as I do own all these stocks. I was quite close to putting some other ones in, like Eurocell. You could argue a case at like Legal and General, Taylor Wimpey. But I decided to go with Barrett. You get a nice little bit of dividend if the construction space starts bouncing back. Obviously, hopefully these guys do very well. But I think there's so many options here. You got MJ Gleason on here. You got Eurocell on here. Taylor Wimpey on here. Few people have been diving into that Vistry profit warning. I think that you could have put any kind of construction company here. I decided to go with Barrett Red Row, and if they do get the cost savings they expect to do because of the Red Row deal, this could actually look very good for them, and the stock should do quite well. You know, you look at the share price to show you how low it is. You are back at the Liz Truss time period, you are back at the CV lows, and any kind of bounce back from interest rate cuts here next year and for at the bottom of the cycle could look a good opportunity. So that's the last one. Hope you enjoyed the video, guys. Apologies that it was very quick fire, you know, 1-2 minutes on each stock, but obviously if I was to do a full 5-10 minutes on the video, we'd be onto like a 3-4 hour video. So I hope you enjoyed the fast fire format. Anyway, have a good weekend. See you in a bit.